This morning, December 26th, 2025, silver snapped into two different prices at the same time. In Shanghai, physical metal traded around $82 an ounce. In New York, the benchmark screen price printed about 76. Same element, same day. Two realities. And that spread is not normal. It is the market confessing that one of those prices is not a price at all. Because here's what actually happened. China, the biggest industrial buyer on Earth, paid up for immediate metal while the Western paper exchange pretended the metal was cheaper. That is the entire story in one sentence. The curiosity is what comes next. Because when the world's largest consumer starts paying a different price than the world's benchmark, the benchmark is on borrowed time. Welcome back. Today I'm going to show you how this split happens, why it's accelerating now, and why it can end with a violent repricing that catches almost everyone off guard. I'm also going to show you the one detail most people skip. The moment arbitrage stops working is the moment the paper market stops being a market and starts being a theater. Let's lock the numbers in first because numbers are the part of this story that cannot be gaslit. Shanghai trading in the low 80s, New York in the mid 70s. That's a gap of several dollars per ounce. Historically, the normal gap is small and boring, the kind of difference you'd expect from shipping, taxes, and currency conversion. What we saw today isn't boring, it's loud. Here's the simplest way to understand it. If you can buy a commodity cheaper in one place and sell it higher in another, traders rush in and close the gap. So when the gap refuses to close, it means one of three things. The commodity can't move, the commodity can't be sourced, or the cheap price is a paper illusion that collapses the moment you try to touch it. Silver is heavy, yes, but it still moves. It moves every day across oceans. So when you see the premium get big enough that it starts to justify extreme logistics like rushed shipments and unusual routing, you're watching a market that is no longer responding to normal friction. You're watching a market responding to scarcity. Now, someone will try to calm you down with a soft explanation. They'll say, it's just local taxes, or it's just currency, or it's temporary. Those lines work when the premium is a few cents. They don't work when the premium is big enough to change procurement decisions for factories. Because China is not buying silver for decoration. China is buying silver for production. Solar, electronics, grid hardware, high-end manufacturing, EV infrastructure, military technology. You can't slap a temporary premium sticker on a factory line that is about to stop because the input metal isn't arriving. So here's the uncomfortable reality. The Western screen price is mostly a futures price. That is not the same thing as a physical price. A futures contract is a promise. It is not a bar in your hand. And the entire global system has been trained to treat promises as if they are interchangeable with metal. That training works until it doesn't. This is where the paper game matters. In New York, the price is discovered through contracts that represent large amounts of silver per contract. Most of those contracts are traded, closed, and rolled without delivery. The system assumes that delivery requests stay small enough that the physical inventory behind the paper never gets stressed. That assumption is the foundation. And the foundation is cracking when the physical market starts paying more for now than the paper market pays for later. That brings us to the word that scares professionals because it reveals the truth: backwardation. In a normal commodity market, future delivery is slightly more expensive than immediate delivery. Storage costs money, financing costs money, time costs money, so the curve tilts upward. Backwardation is the opposite. Backwardation says, I will pay more right now than I will pay later. That only happens when the market doubts future availability or future delivery confidence. It's the buyer screaming, I don't want a promise, I want metal. Shanghai flashing a higher cash price and showing urgency in near-term pricing is not a random curiosity. It's a physical stress signal, and you don't get those signals in silver unless something is tightening. Now let's talk about the second signal, inventories. Paper markets can look calm while warehouses empty. A chart can look fine while registered deliverable stock drains. And when that stock gets thin, the system becomes sensitive to a relatively small surge in delivery demand. That is why you should never obsess only over the paper ticker. The paper ticker is the most weaponized part of the entire structure. If you want to know what's real, you watch the places where metal actually changes hands, the premiums, the availability, the delivery timelines, and the inventory flows. And if you've been watching those, you already know something important. The physical market has been tightening for years, not weeks. Silver is weird because supply doesn't respond quickly. Most silver comes as a byproduct of other mining. That means higher silver prices don't instantly create higher silver production. You can't just decide to mine more silver tomorrow in the way you can ramp some other commodities. The pipeline is slow, expensive, and politically constrained. Demand, on the other hand, can surge faster than supply can respond, especially when industrial use cases grow at the same time. Solar growth, electrification, electronics output, defense procurement. When multiple demand engines pull at once, the system doesn't stretch gracefully. It snaps. This is why a split price is so dangerous. It tells you the paper price is no longer the dominant reference for real buyers. It tells you the benchmark is becoming a suggestion. Now, I need to address the word that people hate because it forces them to admit the last decade mattered. Manipulation, not as a meme, not as a vibe, as a structural reality that was proven in court. A market can be manipulated when paper volume is huge relative to physical availability. That's not unique to silver, but silver is especially vulnerable because the futures market can represent multiples of annual production in paper claims without needing the physical to back it in real time. When a large entity sells a mountain of paper contracts, it increases supply on the screen without adding a single ounce of real metal. That can smash price, trigger stops, and shape sentiment. It can also create a convenient environment for quiet accumulation of physical at lower prices because the screen price becomes the anchor for public perception. Here's the key point. Even if you never mention a single bank name, you can still understand the game. Paper can be created quickly and metal can't. When paper overwhelms price discovery, the benchmark becomes fragile. And when a region that actually needs metal starts paying a different price, that fragility gets exposed. So what does this Shanghai premium actually mean in practice? It means the physical market is bidding. It means someone is willing to pay more than the benchmark to secure delivery. It means the real price for immediate metal is higher than the paper price. And it means arbitrage should be closing the gap, but isn't closing it fast enough. That last line is everything. Because arbitrage is the policeman of global pricing. Arbitrage is supposed to erase lies. When arbitrage fails, lies can survive longer than they should. But when lies are forced to survive by constraints, those constraints become the story. The premium becomes a countdown clock. So let's walk through why the gap can persist. First, timing. Physical shipment takes time. A paper price can move in seconds, while metal takes days or weeks to deliver. When demand is urgent, a buyer will pay more for immediate local metal rather than wait for an international chain. Second, willingness. If holders believe silver is strategically scarce, they demand a higher price to release it. That behavior pushes up premiums and tightens the market further. Third, constraints. Policies, export rules, customs, financing, and compliance can slow movement. Even if the metal exists somewhere, it may not be immediately available to satisfy the highest bidder. And fourth, the uncomfortable one. The paper cheap price may not reflect deliverable reality. In other words, you can buy cheap on the screen, but the moment you try to turn paper into metal, you hit a wall of costs, delays, or outright refusal. That is how benchmarks die. They don't die because of opinions. They die because of failed conversion. Now, here's the part I want you to focus on, because it's the cliffhanger hiding in plain sight. If Shanghai is paying a higher physical price today, what happens when other regions are forced to compete for the same physical pool tomorrow? Because the pool is not infinite. Silver is consumed. Much of it is dispersed in tiny amounts across billions of devices. Unlike gold, which is hoarded and recycled at high rates, silver is often lost. It gets used and it disappears into landfills and products that are not economically recycled. That means silver's industrial demand can be destructive to available inventory over time. So when industrial demand rises, the pressure is not a simple more demand. It's demand that removes supply from the system. And once removed, it doesn't come back quickly. Now, let's talk about the psychological weapon that keeps the system afloat. The screen. The screen price is what most people see. It's what headlines quote. It's what casual investors believe. It's what procurement departments reference until they can't. And because the screen can be pushed around by paper volume, it can be used to create the illusion of abundance even when physical is tightening. That illusion is powerful. It convinces people to wait. It convinces people not to hedge. It convinces people not to secure long-term supply until a factory manager calls a supplier and hears the words, "not available." That moment is when the screen loses authority. And Shanghai is one of the earliest places you see that loss of authority because it is close to manufacturing demand. It is where the pain shows up first. When demand is real, it shows up in the cash price, the local premiums, and the willingness to pay for immediate delivery. So when Shanghai trades above New York, don't treat it like a fun anomaly. Treat it like a warning that the physical market is becoming the leader again. Now, what happens next is usually a sequence, not a single event. Stage one is what we are in now, divergence. Physical premiums rise, paper price lags. The spread gets talked about in niche circles, while the mainstream ignores it. Stage two is acceleration. A key price level gets crossed on the paper chart, and the options market mechanics kick in. Market makers hedge. That hedging pushes price. That pushes more hedging. The move becomes self-reinforcing. Stage three is attention. Once silver prints a headline number the public notices, retail demand surges. Dealers run low, premiums spike. The disconnect between spot and buy it now becomes obvious. Stage four is industrial capitulation. Industrial buyers stop waiting for a pullback and start securing supply at almost any price because the cost of shutdown is worse than the cost of metal. Stage 5 is the response. Exchanges raise margins, volatility spikes, the market tries to shake out weak hands, the narrative shifts to speculators and bubbles. But the physical problem does not go away. And stage 6 is the end game, the part nobody likes to say out loud. If delivery demand grows too large relative to deliverable stock, paper settlement rules can change. Cash settlement becomes the escape hatch. When that happens, the paper price becomes a reference only, while the physical market becomes the real market. The direction of that transition is not hard to guess. The physical price pulls the paper price upward over time, not downward, because real metal is the constraint. And watch the plumbing metrics that almost never hit mainstream headlines. When the cost of converting a futures position into real bars rises, that is the market charging a toll for reality. Traders call it an exchange for physical premium. You can think of it as the price of, yes, I actually want the metal. In calm markets, that toll is tiny because metal is plentiful and nobody is nervous. In stressed markets, that toll grows because the people holding metal know they have leverage. Lease rates tell the same story in a different dialect. Lease is what it costs to borrow physical silver for a period of time. When lease stays low, it means metal is easy to source and lenders feel safe handing it out. When lease spikes, it means lenders are scared they won't easily replace what they lend, so they demand higher compensation. High lease is the market admitting tightness without using the word shortage. Now add a geopolitical layer that can turn tightness into a squeeze. If a major economy decides that silver is strategic for energy and technology, it can favor domestic supply over exports, slow outbound flows, or change the rules around where metal is allowed to go. The moment governments start treating silver like a critical input instead of a commodity toy, the global pool fragments into regional pools, and regional pools create persistent premiums. That is why today matters. A persistent premium is not just a price difference. It is the market drawing a border around metal. Borders are where price discovers truth. Now, you might be asking, does this mean silver is guaranteed to explode tomorrow? No. Markets can delay truth longer than most people can stay patient. They can whip around. They can shake confidence. They can create fake breakdowns and sudden recoveries. They can weaponize volatility to exhaust you. But the premium is not about tomorrow. It's about reality asserting itself. Reality does not care about your emotions. Reality cares about ounces. So let's make it practical. If you're already holding physical, the goal is not to stare at every tick. The goal is to understand what kind of market you are in. In a paper-dominant market, the chart can lie longer. In a physical tight market, availability becomes more important than the daily close. If you're trying to buy physical, you need to recognize the cost of urgency. When supply is tight, the cheapest ounces are the ones you bought before the crowd noticed. After the crowd notices, you can still buy, but you pay more, and sometimes you wait longer. And if you're looking at mining equities, remember, miners are not a single trade. Some are hedged. Some operate in jurisdictions with political risk. Some have cost structures that inflate when fuel and labor inflate. Some are basically byproduct companies where silver is an afterthought. Selection matters. But the bigger strategic point is this. Physical scarcity is the engine, and paper volatility is the noise. So here's the question that should keep you focused. If the world keeps running supply deficits, if manufacturing demand keeps rising, and if key regions keep paying premiums for immediate metal, at what point does the benchmark stop being believed? Because belief is what holds paper markets together. When belief breaks, repricing is not gentle. Now, I want you to think about the timeline. We are not talking about a distant decade. We are talking about the kind of shift that can happen inside a single delivery cycle, inside a single quarter, if enough buyers decide they don't want promises anymore. And if you think that can't happen, remember this. Every major financial stress event looks impossible the day before it happens. Then it happens, and everyone pretends they saw it coming. The spread you saw today is the kind of thing people claim they missed by accident. They didn't miss it, they ignored it. So here's my cliffhanger for you, and it's the one that matters. If Shanghai is already pricing physical higher, what happens when the West finally needs to compete for the same physical supply and size? Not just in headlines. Do we see the paper price chase the physical price upward in a clean realignment? Or do we see the system try to protect itself with rule changes and volatility first? And here's the second question, because I want you thinking like a strategist, not a spectator. If you were an industrial buyer who cannot shut down, would you wait for the benchmark to come to you? Or would you lock supply now, even if the price hurts? Answer those in the comments, because the way you answer reveals whether you understand what this premium really is. If this breakdown helped you see the mechanics behind the headline numbers, subscribe. short, simple, and it tells the algorithm to push this analysis to more people who are still staring at the wrong screen. And keep your eyes on the only scoreboard that matters: physical premiums, availability, and delivery pressure. Because the market just whispered the truth today: two prices, one metal. And one of those prices is running out of time.